Test, test. Okay, gang, it's 5:30, so well, let's get started and maybe we can get you out of here a little bit tonight. Module 10 covers 3 topics. We're gonna talk a little bit about leases tonight, we're gonna talk a little bit about pensions tonight, and then we're gonna end with tax, everybody's favorite tax. So I'm gonna try to do about 20 minutes on each of them. Our authors are getting soft in their old days. The old edition went a lot deeper into some of these concepts. And I always felt like module 10 should really be 3 modules in and of itself. You could have a full night's lecture each on leases, pensions, and tax. And cram them all into one module just seems cruel. So they've adjusted it and they've taken the concepts more high level, which I think is good. It allows us to touch on them in one night. And I'll try to point out some of the estimates and errors in places that you might see the management needs, take issue with some of the accounting. Ask me questions as you go. I expect the questions that you might see pop up on the exam, but it's conceptual in nature. So these some homework that lots of do how to put an operating lease and finance something to that. But other than that, I expect we'll make quick work of this material. Before I jump in, you want to start with any questions? Man, it's been 3 weeks since we connected, we had spring break in there. I don't know about any of you, but we got back from spring break, I find my mindset is that of a toddler throwing a temper tantrum. I don't want to do it. I want to be back on the beach. I don't want anything to do with any responsibility in my life. I want to be vacations are bad. And destroy if you want to.
That's good. And it was, I can't remember. I had a question, but I can't remember like what it was.
When it comes to you, shout it out. You just interrupt me. I always prefer any question to me just document to avoid. So yes.
What beach was it?
We put it last minute. We were planning on going skiing and my wife's family booked the we normally stay at. So he said, I don't go, call the travel agent. I'm like, what do you got? It's last minute. He sent me to Antigua. I've never been to Antigua. But yeah, I think that, Marty, fantastic. Great little island, great people. Tried to drive on the left-hand side of the road for the first time, almost got killed. But came back in Long Beach. Great little sleepy beach resort called Hodges Bay. So if you're looking for a sleepy beach resort, check out Hodges Bay. Yeah, great place to unwind. So anybody else? Did anybody get out of KC, go do something cool? Denver County? Yeah. That's our normal, we usually go skiing. Right, one of the beach vacations, you got one. Okay, let's do it. Let's do accounting. The nice part about module 10 is our whole semester is getting ready to shift. This is financial statement analysis. This is the intersection between finance and accounting. And we've really kind of spent the first 10 weeks on the accounting side of the, we have a little more up there with corporate strategy when we go to the class. But most of this has been heavy accounting, looking at the generally accepted accounting principles, the plus factor that goes into those when we look at estimates and different forms of accounting, how we might make adjustments, and that's all well and good. But now, we're gonna cover 3 topics tonight, and then next week, we're gonna pivot to finance. And finance is all about, okay, now what? And it depends on what kind of user you are. You might work with bank or credit rating agency or an equity analyst or portfolio manager, or so on and so forth, or you might work with corporate finance. But the answer to the question, okay, now what, is typically, that typically takes the form of financial analysts sitting down with a spreadsheet, take all the numbers, assimilate them into some sort of comparative structural intelligence, so that we have a conversation with management team or some investment banker or some portfolio manager and make an assessment about it. So accounting is fundamentally about the past. How do we present the most accurate picture of this business today and prior? Finance is fundamentally about the future. How do we take those numbers that we've been presented that represent history? And how do we interpret them so that they're useful in the future? So next week, we're going to look at forecasting financial. I suspect we'll have some encounter with financial forecasts probably during this 1,000 class or maybe for final class. And then we'll move into various forms of how to actually value the business, whether that's based on historical multiple analysis, industry peer group multiple analysis, we'll do this kind of cash flow, and we'll look at another metric of return on invested capital. But for tonight, we're going to start with leases. And leases got easier too, thanks to FASB. It used to be that leases were another big asterisk in the field of accounting because they presented a lot of opportunity for community. When you lease a vehicle, let's just break down a simple auto lease, or truck lease, or airline lease, pay for pay. Historically, you didn't have to put that asset on the balance sheet. So if you have a $100,000 truck that you're leasing, the only time you're even gonna notice that on financial statements, historically was, when you pay your $1,000 per month lease expense. That was it. That was the entry on the books. You'd have a credit to cash and then debit to the lease expense, and that was something called an operating lease. Contrast to that to a finance lease, which FASB has always required be reported on the balance sheet. And when you put something on the balance sheet and capitalize it, you take that truck, and now it goes into property, plant, equipment, and subject to amortization, depreciation, and interest expense. And you're going to have the debt on the balance sheet. It's like you have the asset on the balance sheet, and usually that happens when I guess we'll just take it right there. they look at the underlying economics of that lease, and they say, well, there's 5 different methodologies that they use to determine that that's a de facto purchase. Then they'll say, well, if you're gonna lease something for 99% of its useful life, that's not really a lease. You've signed a contractual obligation that commits you to pay for that lease expense for the next 10 years. If that represents 90% plus of the useful life of the asset, that's not really a lease, that's a purchase. It's calling it a lease. And you should take those, you should take that expense, you should take that asset, put it on the balance sheet. You should take that liability and put it on the balance sheet. That's the real gotcha, the crux of the issue. That we want to make sure that all the users of the examples understand that there's a liability that this company will be paying for the next sometimes 8 or 10 years. Well, 3 years ago, FASB decided that that was way too ambiguous, and there were too many games going on in the industry. And they said, we're not going to allow you to do expense leases anymore. So I take that back. We're going to force you to capitalize leases. So now everything goes on the balance. Every time a company leases an automobile, that automobile shows up as an asset on the balance sheet. And any corresponding liability associated with that automobile shows up on the liability section of the balance. The only vestigial remnant of the way we used to keep track of it is that there's still 2 differentiated categories. You'll see those on the balance. You'll see financing leases, and you'll see operating. But they're both assets and they're both liabilities. It allows us to distinguish the 2 different types of leases. If I ruled the world, I would just say there's only one type of lease and they're all reported like finance. But I don't rule the world. And that's probably a really good thing. Okay. Little bit of terminology here on slide 1. Know the difference between the lessor and the lessee. On any given day, flip a coin. I may or may not be able to tell you which one is which. It's funny. 2 of the things I struggle with most, and I don't think my brain is ever going to get it right. Lessor and lessee. And every single time I have to teach this stuff for 10 years, every single time I have to say, you know, which is which? Okay, yeah. The lessor, I'm still going to read it right off the screen so I don't get it wrong. The lessor is the owner of the asset. So both of those have an O in it. That helps you out. Lessor, owner. Lessee, borrower. Remember that terminology. Also remember that when it comes right down to it, any lease you're looking at is a private contract. So the terms they can span the gamut of whatever terms you want to negotiate between any 2 independent parties. I'm looking back at my time here on the block, at the block school 25, almost 30 years ago now. When I completed my MBA, as I look back, one of the most valuable courses that I took, at least for me, now that I've been in the world of business for 30 years, was contract. Right during law school, there was a requirement for the MBA program at that point in time. Still a requirement? No? If you have any elective time, take contract. And you're going to learn a lot about what it means for 2 independent parties to sit down and negotiate something and put that on a piece of paper that's enforceable by law. And then exactly how that's enforceable by law. You have a contract between 2 independent parties. What does that mean? And what are the obligations that those parties have just agreed to? And when one of those parties thinks that they've been wronged by the other party, what happens next? Well, you're going to run into that if you spend any significant time in the world of business and have a little bit of background about how all that gets formatted, and the contractual nature of it is a really big deal. Where that's impacted me in my business career most significantly is in operating agreement. So an operating agreement is a contract between any 2 people or any 2 parties or any 2 corporations that come together to found another company. So like I own a company with two partners. And my partners and I have an operating agreement that defines what the business is, how it's gonna be funded, who has voting rights, and how those profits are gonna be split. All the little details about how that company's gonna be run. So if you ever feel like you're getting a raw deal, or you're been wronged by something, or you wanna tie something, a third party to a non-compete, or some other standard type of agreement that you see all the time in operating agreements. Business law will, give you a great foundation for that, but that's inside. Okay, financing lease, this looks like a purchase, and so we're gonna record it like a purchase. So remember I differentiated between a financing lease and an operating lease. And our authors hit on a couple of bullet points here that define what a financing lease is. Leases usually require the first lease payment up front. Oh, that's just in general lease terms. I'm getting that myself. So here's how you'll see Microsoft in this case, or whatever company that you're doing your research project on this semester, disclose the details behind their leases. And I want you to go in your 10K, just like with every single one of these topics. We're gonna be talking about pensions tonight, we're gonna be talking about taxes tonight. I want you to go in your 10K filing and read the fine print associated with all of those different subject matters. To again, come to some determination about materiality. And you gotta read the fine print to make that determination. So for Microsoft, maybe they've leased some big fab facilities, like in their production space, but Microsoft's a software company, so it's gonna be very unlikely that leases as a category will be material to your valuation. But for another company like Southwest Airlines, that leases all their planes, this is gonna take a whole bunch of your time. Because you're gonna have to understand exactly how they're recording leases, and you're gonna have to reconcile for any of the different accounting treatment that might apply to Southwest Airlines. If they're recording an operating lease here, and a financing lease there, because when you get down to your peer group comparables, that account is gonna be the same. If you compare Southwest Airlines to American Airlines or Delta, not only are you gonna have to review the Southwest lease treatment, but you're gonna have to familiarize yourself with American Delta or whoever else you can get out of comparison. Fortunately for you all, again, I want you to do this. Artificial intelligence will help you do that. We have formed, I'll bet I'm way behind people in this room. But we have formed, a weekly, bi-weekly artificial intelligence, like think tank inside of our financial advisor. It's like the 4 people on our staff that are either most interested in it or have most experience using it. And we're integrating it across marketing, sales, just general email. I listened to a webinar today on preparing PowerPoints with artificial intelligence. And this was sponsored by Fidelity. And they also touched on this aspect of analysis. So this is a very easy prompt for you all today. It used to take real work to do this, but now you can go to ChatGPT and say, I need to compare the lease accounting treatment for Southwest Airlines versus American Airlines and then versus Delta Air. Can you point out any differences and highlight any areas of concern? And then ChatGPT is going to do the analysis. Now you can't take that and copy, cut, paste it into your report, because think about those artificial intelligence programs as being right 65% of the time. They're fantastic, and I start there with almost everything in my day-to-day now, and I'm encouraging you all to do the same, because if you don't, you're gonna be behind when you graduate, so use it. And then we're kind of still in the stages of figuring out together what happens next after we use it. First, we have to teach ourselves to be experts on the program. Next, we have to teach ourselves how to be, useful and salaried members of whatever organization that's paying us, so that we can bring more value than just the artificial intelligence. And that's all kind of still being sorted out, which is why we have this task that needs bi-weekly. But that's a great opportunity to analyze lease accounting or whatever else that you might have an interest in, because you can download the PDF file of your 10K. So if you go to the investor relations website, download the PDF file, maybe you do that with Southwest Airlines, American Delta, upload it directly into ChatGPT, and then just say, please analyze the lease accounting. And then, why stop there? We have 10 modules in this semester. Upload the 10K file or whatever company you're working on. Ask them to analyze it piece by piece. Remember, I want those research projects organized by module. Each module could have its own appendix with a little bit of analysis on your part, pointing out anything that's may or may not be relevant and commenting on the significance. With real analysis, if it is significant, real analysis if it is material. But that real analysis can be done through ChatGPT. You just have to verify. I've also started using Nova. Anybody use Nova? So Nova, near as I can tell, is like an aggregator of artificial intelligence programs. So you go to Nova, and it's like a front door to this whole new world of AIs, and it'll help you route your prompt to the appropriate AI. So through Nova, if you go through that door, you get access to Claude and ChatGPT and Perplexity and maybe another app. So I started to use that a little bit, and I think ChatGPT caught on to what Nova was doing. Because now when you go to ChatGPT, in the upper left-hand corner, you can click on a button that says explore other AI. And ChatGPT will go out to other AIs and run some queries. And I've started using Grok, which is Twitter X's artificial intelligence. And now I'll use, so because they're only 65% correct, and I just picked that number out there, but I know they're not always correct. So now I'll use one platform to distill my analysis for the day. I wanted an analysis of Ukraine. One of my clients had asked me about Ukraine. I wanted to make sure I had my facts straight, because they wanted an informed opinion. Really struck me, but I feel like I was informed to comment on Ukraine, but I'm a lot more knowledgeable now than I was. So I went out and used ChatGPT to help answer a bunch of questions that I had and gather some data, some time back, something that was real or truthful. And then I took all that and I uploaded it into Grok, and I said, hey Grok, fact check all these data points with me and verify that they're legit. And put another 10 seconds, and I had them all fact checked. Then because it was for a client that I asked, I went out and put it on the individual and verified it myself. But just amazing what it can do, and it really rattles my cage a little bit, because I know if we're not on the cutting edge of this, we're going to get out competed by a lot of people who are lobbying for our business. Okay, look at the balance sheets of all of the companies you're analyzing, but in this case, I think we're still on Microsoft. You're going to see we're looking at the balance sheet here, and these leases show up. If they're a financing lease, remember we're recording that as if it were a purchase. So that's easy. We all know how to record a purchase of an asset. So it shows up in property, plant, and equipment. If it's an operating lease, we're going to record it as an operating lease right of use asset. So right of use is exactly what it sounds like. We don't own it, and the lease isn't so significant that we're going to act like we do own it, but we're still going to put it on the balance sheet underneath some label called right of use asset, because that plane is painted with the Southwest logo, or that truck is painted with the JB Hunt logo, and it's in our fleet. Then on the liability side, you're going to see that the operating lease is down here under operating lease liabilities, just like the asset was operating lease right of use assets. The financing lease, oh, that's just long-term debt. Took on debt, buy an asset. That's exactly how we would report a purchase. And then both leases have the component of the current component of that debt recorded in the current portion of long-term debt. Okay. These are the 5 terms that I mentioned, which will differentiate between an operating lease and a financing lease. Transfer of ownership. If the lease transfers ownership at the end of the lease, that's obviously fine. There's no difference at that point between a lease and a purchase. Purchase option, if you get to the end of the lease and there's a bargain purchase option, that is a no-brainer. Anybody's gonna take advantage of it. You buy the vehicle for a buck at the end of the lease. We're gonna record it as a financing lease. Lease term, I mentioned, if the majority of the lease term occupied 90% of the useful asset life, then that's a financing lease. Present value. I don't remember what the terms were around. The present value of the sum of the lease payments and any residual value guaranteed by the lessee equals or exceeds substantially all of the fair value of the underlying asset. Okay, well, substantially all. That's a little vague. I don't know what the generally accepted threshold is for substantially all. That may be another pocket of accounting where there actually is some room for error or estimate. And then lastly, specialized asset that you're not going to be able to sell off in the general marketplace. These 5 terms make for a good conceptual test question. I'm going to highlight a couple of slides on here that you can bookmark for an open book test. All of our tests are open book. You can bookmark the conceptual slides. That's going to make it a little bit easier on you. Bear with me here. I had made some notes this afternoon, just sitting right in my office. So I want to make sure I get all my comments. I had the best and the worst April Fool's Day prank ever pulled on me this morning. We're finishing our master bathroom. And last night, this really happened to me. Last night I get home and I find all of these buckets set up in our dining room because our contractor was installing our sink and one of the fittings exploded and water flooded our master bath and drained through to our dining room. So all these buckets are catching the water, and I'm like, oh man, this sucks. So he's gonna redo our ceiling. And I called him last night and I say, Chris, one of the fittings sprung a leak again because it was still leaking. And we had gone through 2 buckets of water, and I go up there and I'm like, it's not a torrent, but it's still leaking. And I said, well, I'm gonna have to shut the water off to the house. So we did, and we went without water for a night, and he promised he'd be there at 8 o'clock to restore our water. Okay, so I go to sleep and I get up this morning and he texts me and he says, hey man, I'm not gonna be able to make it. And my face just turns red. I'm livid at this point because the guy has flooded my master bath. I got water all over my dining room. He's directly responsible. He's like, April Fool. I'm like, that's pretty ballsy. That's pretty ballsy. But I got a kick out of it. Okay, slide number 10. Okay. This is a good table. This will help you identify whether or not your leases are material. You're going to find this disclosure in the back of your 10K, and it's going to sum total all of the lease payments that are due over the next 5 years. So for a company like Microsoft, I think these are in millions. So, well, so if these are in millions, they have 13 billion. Yeah, 13 billion lease payments due over the next 5 years. Next question is 13 billion material for a company like Microsoft? 30 million cents of material for any company, and then you start thinking, well, Microsoft has $1 trillion market cap, so we're talking about something that's less than 1.3% of their market cap. You know, material is usually a couple percentage points or more, so yeah, you're close. But come to some determination in that regard. How do you determine the value of the asset that we record on the balance sheet? We determine the value of the asset that we record on the balance sheet by using a simple present value formula. Generally, what you're gonna know is the lease payments. Operating lease payments. We have year 1, 2, 3, 4, 5. Those are typically clearly spelled out in the contract that you sign with the lease. Then you also usually know the value of that. So if it's a car, you know the sticker price, you know what it's worth, you can look at it. So if you have those two things, you can plug them into a spreadsheet and calculate the present value of that asset, which is probably going to be the sticker price of it, you know, the value. What this spreadsheet allows for you to do is also compute the interest rate associated with that asset. And the interest rate associated with that asset, well, it's not always clearly stated, but we can get to it if we know the payments by solving for the internal rate of return. The interest rate is important because we have to put that on a statement periodically. So when we have an operating lease and we record the asset on the balance sheet, the liability on the balance sheet, next quarter, we have to record an interest expense associated with that asset. And a simple spreadsheet will help us solve for that. And this is another example of the implicit rate of return. Yep, so we're using a simple IRR formula here. We have the value of the asset, in this case it was 13.7, and times 0, we have the lease payments extending out over a 10-year period, plug all of those into an IRR formula, and this solves for 2.1%, which is very, very low. I think this example was done in 2002, so that's probably relevant as of 2002, but you couldn't get those rates today. You wouldn't know what the 10-year rate is. So as a portfolio manager, this won't surprise you. Every day I check on the market, and I have a go along list of tickers, and I organize that list based on the assets that our clients have in them. So I'm always keeping track of the S&P 500, as you can imagine. There are a bunch of different mutual funds that have clients in the individual stocks, and those holdings are ranked order biggest to smallest. Well, above any of them, because it's a benchmark for interest rates, and it determines things like mortgage rates and leases and the general pace of business across our economy, is the 10-year treasury rate. The 10-year treasury rate today is 4.65%. So there's no way you're going to be able to get a lease at 2.1% when the treasury is at 4.6 today. You're usually going to pay an additional 1 to 2 to 3 to 4, depending on your credit rating, over the 10-year treasury. So when I see 2.1, I'm like, okay, it's outdated, or there's something fishy going on with these numbers. Good. Almost done with leases. One more point I wanted to make. Nope, already made that point. And slide 18 is your summary slide. So this, start this, bookmark this, come back to this slide on an open book exam, and you're going to get a quick refresher on the differences between an operating lease, a financing lease, and how they're reported on the income statement and the balance sheet and statement of cash flows. Okay, let's move on to pensions. So I know we've touched on other comprehensive income a couple of times in this class. I call it the junk drawer. And when we touch on other comprehensive income, pensions always get brought into the conversation because pensions can fluctuate massively. And as he wants to make sure that those fluctuations don't distort the normal pace of the income statement or amount. So we put those fluctuations in the jump drawer and then we amortize that over time. I'm gonna go through that example tonight. So I would like to share my grandfather's experience. I apologize if you've heard the story already, but my grandfather worked for Phillips 66 for 40 years. And during that 40-year period, he accrued rights to a pension benefit. And those rights accrued pretty steady, year after year after year, he would accumulate more rights. And he knew when he retired at age 65, he was gonna start getting a check. And Phillips 66 knew that when he retired at the age of 65, he was gonna start getting a check. So the accounting for that is a real bear, because Phillips 66 had tens of thousands of people like my grandfather who were gonna be entitled to pension benefits. So imagine that, my grandfather retires in 1985. He had worked for 40 years. So beginning in 1945, in the late 40s, I'm gonna give a lot of my head, with my date. But beginning in 1945, he started accruing benefits. So beginning in 1945, Phillips 66 has to start accruing a future liability. Now, they don't pay him for 40 years. Every year he's with the company, he accrues a bigger benefit. Year after year after year, his benefits grow and grow and grow. 40 years later, Phillips 66 has been booking larger liability, larger liability, larger liability, this whole time. They owe my grandfather a pension benefit. 40 years later, they start paying that benefit. They start paying that benefit to my grandfather in 1985. They pay that benefit from 1985 to 2002 when he dies. That benefit is a surviving spouse benefit. So it continues to be paid to my grandmother from 2002 to today. She turned 94 on March 29th. He's still going strong. So that is a liability that Phillips 66 has had to accrue for and pay and account for and budget that began in 1945 and continues today. So it is 2025. So that's how many years is that? 65 plus 25 is 80 years. 80. It's a long time. So now take that math, that 80-year liability accrual and payment, multiply it times tens of thousands of employees, and let's do the accounting. You can see very quickly how the liabilities are going to number in the billions of dollars, tens of billions of dollars. That's what I used to do when I graduated from law school. Shortly thereafter, I got a job working for a pension consulting. So we were clients like Phillips 66 was not a client, but Boeing was a client, Coca-Cola was a client, Maytag was a client, Price Waterhouse was a client. Then we would go in and we would help them manage these liabilities. Now, ideally, if you're doing this right, then every time my grandfather, or really all of your employees, hang out and work for another year, and what you owe them grows, we take a little cash and stick it in an investment. And ideally, you save during that period of time you're accumulating liability, the investment account grows, the liability grows, the investment account grows, and those two kind of mirror each other. And in a perfect world, they cancel each other out. You have a benefit, you have a pension benefit obligation, which is the liability on your balance sheet, and you have a pension investment account. It's an asset. Those two are even. They just cancel each other out in a perfect world. But we all know that periodically the market goes crazy. So when you go back to COVID, where you had a 30% retracement, or go back to the great financial crisis, and then 500 lost 55%. And a year like that, when you're managing liabilities that are $50 to $100 billion, you have $100 billion investment. and you lose 50%. Lost $50 billion. And if FASB didn't allow us to put those fluctuations down in the drug store, then we would have to run a $50 billion loss through the face of our income. That isn't fun for anyone, because the rest of the business is going to fall. The war by that 1 year's loss. Now, over time, they should smooth, they should cancel each other out, and generally speaking, that's what happens. But it can get a little complicated. Contrast that whole story I just told against the modern day 401k. Defined benefit pension plans, which is what I just described, they're good, they're really good. You don't find them very much anymore. If any of you stumble into one, I would be very, very surprised. But they still exist because these promises have been made over the last 8 years, and we have to know how to account for them. So when you all go into the workforce today, you're going to get something else, and that something else is called a 401k, where the company is not making any promises. They might match part of your savings, but that match is legally required to be deposited today in a 401k savings account that's registered in your name, which means the company doesn't have any ongoing liability associated with that. They just discharge their liability immediately, pay period by pay period. So we record for the 401k expense, just like we record for a wage expense. They're done. 401k, piece of 401k is the same as wages. Wages payable is credit, cash would be the debit, and you can move on. The defined benefit plan is where it gets tricky. Okay, let's start with a little bit of terminology. Projected benefit obligation. That's what accountants call what we owe. When you look at all the math across your entire employee base and the benefits that they've accrued, that number in total is called the projected benefit obligation. And the projected benefit obligation minus, when we subtract the value of our investment account, is going to equal something called funded status. So that's what I want you all to go out and find. If your business has a defined benefit pension plan, I want you to find out if it's funded. And hopefully it's fully funded. Or you might find out that there's a deficit. Calculate the percentage of funded status. So if it's 100% funded, that's ideal. If it's 80, 90, that's fine. You can, I guess I've never put two and two together before, but you can loosely tie that to an A, B, C, D, E, F grade. So if you're 90, that's pretty good. That would be an A. If you're 80, that'd be a B. If you're 70, that'd be a C. That's probably right in the middle of your bell curve. If you're going to score corporate America, most of them would be somewhere between 70 and 80. And then anywhere under 70, you're getting a little sketchy. You're having real concern about that business's future claims paying ability. Okay, settlement rate. Also find out what the settlement rate is. So this is the amount discounted. So this is settlement rate. You also hear this referred to as the discount rate. To calculate the present value of those future benefits, we have to discount them back to time zero. We got to discount them back to today so we can put that number on our balance. And this is the biggest opportunity for shenanigans. Because how do you determine the discount? You're going to benchmark it to something like the 10-year, probably. And then you're going to say, okay, well, companies, generally speaking, you can tie it to like the capital asset pricing model, which we haven't talked about yet. We'll do a refresher on that in a couple of weeks, but I know you're all familiar with it. Dr. Clark's investment class or Dr. Mark's finance class, whatever. You can use the capital asset price model. There's another couple of handful of techniques that you could use. And just like everything else that we've discussed all semester long, when you have 2 or 3 techniques that you could use, that introduces subjectivity. And when you introduce any measure of subjectivity into a settlement rate that's discounted cash flows that could be paid 40, 50, 60 years in the future, well, you'll recall that you've done any sensitivity analysis at all on the discounted cash flow statement. That discount rate is one of the most sensitive numbers that you'll ever put into a spreadsheet. So even the smallest differential or tinkering with that number is going to result in big moves in that PBO. So when you have big moves in that PBO, you're going to have big gains and losses flowing through to the income statement, which is another reason why we push all those gains and losses down into other numbers today. What would you expect, just high level theoretically, if we could get a little discussion going here? What would you expect that settlement rate to be? Like if you look in the back of your book of the 10K file, task, all you would finding that settlement rate if you have to find that in the pension plan. What's a red flag? What's a green flag? Like if I told you that, okay, Phillips 66, ConocoPhillips now. Conoco's got a settlement rate of 5%. Does that sound good? Sound bad? Put it all into the spreadsheet. The lower the settlement rate, the lower the discount rate, the higher the present value. Higher the present value, the projected benefit obligation that we're calculating. So the lower the settlement rate, the more we're going to say that we owe, the higher the liability is today. That's associated with conservative accounting. Low settlement rates set a low bar. If we have a settlement rate that's 5%, I just told you that the 10-year treasury is yielding 4.6. So it seems pretty likely to me that we could go earn a rate of 5%. So the settlement rate, another way of interpreting that is that this is the rate of return that management is assuming the investment portfolio will earn to match those liabilities. So here's the red flag. You see settlement rate and it's 9, 10, 11%. That's the red flag because management is communicating to the markets that they think they can earn 9% on that investment portfolio. They have to earn 9% on that investment portfolio, or they're not going to meet those future obligations. So if their funded status is 100%, but they have a 9% settlement rate, then it's your job as the analyst to recast that. Remember that term, recast. You're basically building the financial statements again under new assumptions. Build those financial statements again under new assumptions, with that new assumption being a safer settlement rate of say 6%. And when you adjust that settlement rate, watch that funded status go from 100% to 90 to 80 to 70 to 60 really fast. All kinds of secondary effects on a funded status of less than 70%. Because employees start losing confidence in the claims paying ability of the business, and you're going to have talent flight. I mentioned this one, funded status equals PBO plus pension plan assets. Pension plan assets, that's just a securities account. Most commonly, you see pension plans that adhere to a 60-40 type ratio between stocks and bonds, maybe 70-30 type ratio between stocks and bonds, depending on what bonds are yielding. Every once in a while, you'll still see something called immunization. Immunization is the safest pension plan management strategy that you can implement. It's also referred to as liability-driven investing. Let's break this down as if you were one investor inside of that entity. You're one retiree. You retired at the age of 65. Your life expectancy is 90. That gives you 25 years worth of retirement. So, if you retire today, you have 25 years worth of retirement. What you would do is you buy a CD. You buy a CD that matures in 2026. If you need $100,000, you put $99,000 into a CD that matures in 2026. The value of that would be $100,000, and then you have your expenditures for that year. That's guaranteed. You mature of that FDIC. You don't have to worry about it. No risk. So you put it in guaranteed interest. And then you do the same thing inside of CD that matures in 2027. But it's similar. 2027 rolls around on the calendar, that CD matures, it's guaranteed. You don't have to worry about the money being there. Cash out that CD. Then you do the same thing with a CD that matures in 2028, 2029, 2030, 2031. And you can sleep easy because you know that you have your investments allocated in such a way that the cash is going to be there when you need it. And that's called a liability-driven investing strategy. It's also called a bond ladder. So you can match those liabilities. Most pension funds don't do that because most of the time, if they take on market risk with those investing portfolios, that's going to pay off. So if you use a bond ladder, you're going to get a rate of return at about 5%. You put your money in the markets, most of the time you're going to get 8 or 9%, but that's not guaranteed. And you could end up with 4. You end up with 4, that has bankrupted a lot of it, which is one of the reasons why you don't see the concept of pension plans anymore, because the railroads were bankrupt, because a lot of airlines in the early 80s were bankrupt, because a lot of the businesses didn't do the accounting for these pensions like they should have, or they weren't as prudent as they should have been with squirreling away their investment dollars. And ultimately they went bankrupt and weren't able to honor their promises. You think of your question yet?
Yeah.
You did? What was it?
It's kind of like, it was about, I had to pull up. I don't know, what you have, like one of the research project,
Yeah.
the one that's in Excel.
Yep.
How do I like, I don't know how to get it out of Excel and.
Into the Word file.
Yeah.
So what you want to do is, that's called the Excel template. Take the Excel template, populate your revenues, growth rates, margin, the discounted cash flows all plugged in there for you. And then you go file, print. And in the print menu, the drop down print menu, you select PDF, and then you save it as a PDF. So now you have the Word file. You're going to do the same thing with the Word file. When you're all done with your report, you're going to go file, save as PDF. Then you're going to go file, save as PDF for the cover page, which is in that same file. And you're going to file, save as PDF for the discounted cash flow. So they get 3 PDFs. Then you go to a free utility called Combine PDFs. Upload them all. Drag and drop off the first one, the second one, the third, merge. Then you go to formatting that you see from the reports like fall number, give it available. And if you run into any problems, send me an email and remind me to put that in an announcement to the class, because I'm sure you're not the only one with that one. Okay, service cost is what I wanted to talk about next. Terminology. Let's see, that's on slide. My eyes are getting bad. 35. Here's the table you're looking for in the back of the 10K filing, just like everything else. That's going to have the disclosures with regard to how these major categories have moved year in and year out. You're also gonna have this disclosure, which has the future benefit payments associated with US pension plans, future benefit payments associated with international plans. International plans are not necessarily required to be disclosed at all, which is another big amorphous category of potential future liability. So that, you really gotta think with your analyst hat on when it gets to international plans. You have to look through the lens of materiality. You wanna make sure that it's material, and if it is, you might have some real number crunching to do on international plans. And the same when it comes to post-retirement healthcare plans, because these are not required to be listed anywhere on the financial statements. The only place you will find post-retirement healthcare plans and the liabilities associated with those are in the fine, which is really pretty. I find that pretty interesting, pretty mind-blowing, pretty alarming. Pick your word, that $610 million worth of benefit payments. And that's just through 29 through 23. If we total up all the years, looks like 6, 7, 8, 9, just call it $1 billion worth of future payments are disclosed nowhere except for the fine print of the table that you'll find at the back of the 10. You gotta be kidding me. There's just $1 billion that we owe. That's why it pays to understand how to read a 10K file. Okay, terminology. Service cost is the only one that I really see students have trouble with. Interest cost, interest cost. It is what it is. We use the discount rate to calculate interest cost. That's not a terribly tricky concept. But service cost is the notion that my grandfather or another employee accrues additional benefits as they just come to work. It's 2025. If we put our time in and accrue future benefits, with each year that passes, we refer to that as service cost. So we will report that as an expense on our income statement. So we have pension expense. The pension expense breaks down into several different categories. One of which is service cost, the year-to-year accrual of additional benefits. Another of which is interest cost. And then we're going to compare that to investment returns. And if service and interest costs perfectly match investment returns, then pension expense will be zero. If they don't perfectly match, and in some years we might get a wild fluctuation, then we're going to take any difference, report it as a gain or a loss, and post that to other comprehensive income. Put that in the junk drawer. And then that other comprehensive loss that we have in the junk drawer, we're going to amortize that over a period of 10 years. So if we just took $1 billion loss, we're going to amortize that over a period of 10 years, which means that we're going to factor that into our pension expense. Next year, we're going to record pension expense according to the formula that we just walked through, plus or minus any gain or loss that we're amortizing from prior recognition of other comprehensive income. Actuarial adjustments to the final component of pension expense. We also put these in the junk drawer, and we will also amortize these over time. Periodically, we just don't get it right. Pensions are governed by actuaries. Actuaries help us calculate things like how many employees we're going to have, how long they're going to live, how long their spouses are going to live on average. When we have to make adjustments for things like wage inflation, if we didn't get wage inflation correctly, we know everybody's salary is going to go up. And we know that pension benefits are generally tied to a percentage of salary in your final 3 years of employment. So as salaries rise, we have to factor that in. So we make estimates. And then later, when we find out that our estimates are wrong, because they will be wrong, we have to make actuarial. Sometimes those actuarial adjustments will make our pension benefit obligation go up. Sometimes they will make that pension benefit obligation go down. Those changes post to other comprehensive income, and they are amortized over. So we may adjust wage inflation, years of benefit payments, discount rate, investment returns. Pensions are contractual. Back to that contract law class that I was talking about, because pensions are contractual. The agreement the company has with an individual employee could be for a period of years, it could encompass 50% of the salary, 80% of the salary, it could include the spouse, it could not include the spouse, it could include healthcare benefits, and it doesn't include healthcare benefits. You can put anything you want in the contract. Okay, let's talk about taxes. Okay, analyze and interpret tax report. And when I was a student, years and years and years ago, this kind of blew my mind. But now that I've been in business for a while, it's still. Companies need to set a book. And by the, if you come away with nothing else from this course, then the accounting, it's the old joke. The old joke. The boss goes to his accountant and he's asking him, I forget how the joke was, the punchline is, like, asking him about the numbers, he's like, this would be a lot easier if you just tell me what you want the number to be. And then the CFO will work with all of the accounting that we've been going through all semester long to get the number that's the bottom. And that's exactly how questionable accounting can be at times. So we do keep the books, we keep, I'll talk about my business, we keep a set of books for, GAAP, generally a set of accounting principles. We keep a set of books for the IRS, because those two things don't always align. The IRS gives us the opportunity to accelerate the recognition of expenditures, to accelerate the recognition of capital expenditures, to use different depreciation methodologies. And in some regards, the IRS is more strict than GAAP. I'll point out a couple of there. We keep a third set of books because we have a contractual relationship with a minority partner, and that minority partner has a class of shares that does not entitle them to participate in certain distributions. They're not entitled to participate in any distributions associated with employee benefits. Okay, that little stipulation requires a third set of books. And then we keep a fourth set of books for the bank, because the bank wants to see a particular calculation of the fixed charge coverage. So all of those require very slightly different accounting. Tonight, we're going to talk about the difference between GAAP and IRS accounting and what happens when they don't match. Because when there's a difference in GAAP and IRS accounting, the expenditures that we show for GAAP won't allow us to reconcile our free cash. We have to be able to reconcile the cash that we actually have on the books with the expenditures that go up on the income statement. When there's a difference between what we pay the IRS and what we record in expenses for GAAP, we gotta plug the hole. We're gonna plug that hole with a deferred tax asset or deferred tax liability, depending upon whether the taxes we paid were greater than or less than tax expenses reported on them. So again, it's funny that two of the concepts I struggle with most, just because I don't know why. It's lessor and lessee. And here we are with deferred tax asset and deferred tax liability. Every time I hear, I'm like, okay, deferred tax asset. That's a benefit that will show up in the future, an asset on our books today. That means we're gonna pay less in the future. The deferred tax asset gets booked. You can see the wheels just turn so slow here. The deferred tax asset shows up on the balance sheet when we pay the IRS more money today than we book in tax expense today. tax expense on the income statement will be lower than the cash tax paid to the IRS. When that happens, we book a deferred tax asset. When it's the other way around, and the tax expense we book today is less than the cash we pay to the cash we pay to the IRS, that connotes a liability that we will owe them in the future. We'll plug that hole with the deferred tax liability. Let's go through an example of each of those. Hopefully it'll clear it up a little bit. The first and probably simplest example of the deferred tax asset is going to be depreciation. So when I think about depreciation, I think about straight line depreciation as being the simplest and oftentimes most accurate. But the IRS gives business owners the opportunity to record an accelerated depreciation. Those two things don't happen. For GAAP, we can choose one method, and for the IRS, we can choose another method, which is weird, but oftentimes that's one of the incentives that the IRS and the government in general will use to stimulate spending. You know, they would say, you know, if you go out and buy a new truck, we'll allow you to expense that all in year one, or all in years 1, 2, 3. And that makes it a lot more powerful to make it a purchase. So what you observe is that if GAAP is using straight line, well, this chart kind of says it all. In year one, you'll have $100 expenditure for GAAP, and you'll have a $200 expenditure for the IRS. Well, if your tax expense is $100, but you pay $200 to the IRS, you're going to have to book a deferred tax asset, plug that hole. And you can see, if you're committed to these depreciation schedules, then that deferred tax asset, which plugs this hole in year one, is going to reverse itself as you move from years 3 to 4 to 5. And by the time you get to year 5, you will have completely written that deferred tax asset off, because now your tax expense is greater than the payment that you just made to the IRS. So let's look at an example. We have GAAP in the first column here, and we have IRS in the second column here. Our income before depreciation is $200 for financial reporting, and it's $200 to the IRS. The depreciation method that we use, straight line 50, accelerated 75, that makes our income before tax 150 and 125. Then we have a tax rate of 40%. So that means 60 for GAAP and 50 for the IRS. And then our net income is 90 and 75. So that's a very simple example whereby the expense that we record on our 10K shows 60, and we only spent 50. We only sent 50 to the IRS. So we have a $10 hole to plug here. So we're going to account for it like this. We know that we just spent $50 in cash, so that's a credit to cash. We're going to need to debit a deferred tax liability for $10, and then our retained earnings will match the net income that we recorded for our GAAP financials, $60 credit. Okay, let's reverse that. In this example, we only have 2 years. So in the second year, the deferred tax asset reverses itself. We have the same income. The depreciation for straight line GAAP is still 50, but now the accelerated depreciation is only 25. Income before tax, 150 versus 175. And you can see the income tax is still 60 for straight line, but now it's 70. So now we're paying the IRS more than what we've recorded for tax expense, $10 more, and that deferred tax asset has entirely reversed itself. And you're going to see that when we account for it, we now have $70 in cash that we credited, and a debit to deferred tax asset for negative cash. Or actually, this is the deferred tax liability. So really, what if you have a positive sign in front of that number, you record it as deferred tax asset. If you have a negative sign in front of that number, it's a deferred tax liability. You think of the over under 0, and on one side you have the asset, and on the other side you have the liability. That's all disclosed again in a 10K filing of the in a table of factors. Two examples of timing differences, these are called timing differences, whenever you have a difference between taxes paid and taxes expense. Two examples that will result in deferred tax liabilities include restructuring costs. You might remember a discussion from earlier in the semester where I noted that restructuring costs require, first they require approval by the board, but then secondly, they require an estimate of all of the severance that you're gonna pay employees and any wind down costs associated with getting businesses disposed of or moving the property where settling business. You might have tens of millions of dollars worth of restructuring costs that you want to push through your income statement, and you record those all on day one. That's the way you do it. Forget. The IRS says, well, no, we're not gonna allow you to deduct tens of millions of dollars just because you say you're gonna do something. You deduct those expenses as they're actually expensed. So this is an example where the tax expense that you record on your income statement for GAAP is gonna be much lower than the taxes that you actually pay the IRS, resulting in a deferred tax liability, which will reverse itself over time as you actually pay those restructuring costs. Another example that will result in a deferred tax liability is a net operating loss carry forward when a business loses money. And we lose $10 million. The IRS allows for that loss to be carried forward into the next year. So if we make $20 million next year, we can say, well, we lost $10 million last year. So we're only gonna pay taxes on the net difference of $10 million in total profit. That's called a net operating loss carry forward. And when you have a net operating loss carry forward, you'll also have a deferred tax liability associated with it. Find this table at the back of your 10K. It's gonna have a detailed analysis of all the deferred taxes, both assets and liabilities, and where they resulted from. So deferred tax assets and liabilities can result from operating loss, tax credits, employee benefits, share-based compensation. Every single one of these categories represents tax law that is different between GAAP and IRS. Fortunately for you all, that's another whole semester of tax class. And I am not qualified to teach, but it is some detailed stuff. Okay. The last thing I wanted to comment on tonight is something called the valuation allowance. This is associated with net operating loss carry forwards or potentially even other deferred tax assets. But let's talk about net operating loss carry forward. When you're in a big loss position, that has value because you know you can take those losses and use them as a tax shield against future earnings. And that has sparked M&A opportunities in the past, as acquirers are often very attracted to businesses with net operating loss carry forward, especially if they're in a professional net loss. There's a lot of tech companies out there that never reach profitability and just accrue never net operating loss carry forwards in their books until they went broke. Well, to an acquirer that is already profitable, those can be very valuable. You can buy that business today, capture all those net operating loss carry forwards. You're profitable, so you're going to monetize them immediately. Compare that to the standalone company that might have taken another 5-10 years to reach profitability. A valuation allowance shows up on the financial statements when the auditors come in and they look at a deferred tax asset, a deferred tax liability associated with a net operating loss carry forward, and they say, we don't see a path to profitability. We don't think it's reasonable for you to report a large asset on your books associated with a net operating loss carry forward that requires you to be profitable. We don't see that happen. And so we're gonna require you to report something called a valuation allowance against them that right sizes that number to something that seems reasonable. That's as big of a red flag as I've ever seen. When you see a valuation allowance on your financial statements, I want you to recognize that red flag. I want you to think about the compensation that's happening inside that company where the auditor came in. The auditor that has more access to the books and records and methods than anybody outside of the management team itself. And that auditor with that much access didn't see a path to profitability. That's a big problem, a big red flag, and I want you all to be aware of it. And I think, gang, I think that is it. That is it. So that's tonight's lecture. Thanks, Zoom crew. We'll be back in a couple weeks. We're pivoting to finance, and the rest of the semester is going to go really fast. So start thinking about that research report.
I just quick on the research report.
Yeah.
I started mine with the 10 that was available as of the 25th, more recent one. Published 2024.
You can use the old one. I used to always tell students to use the old one, because I don't want you to have to redo all that first stretch. But now, with ChatGPT, there really not that much new work. So I would encourage you to explore ChatGPT